Hello traders, this is another lesson in technical analysis. I think today we'll talk about chart patterns. Chart patterns are probably like one of the most respected tools when trading. I'd recommend, highly recommend that you use some form of chart patterns or not. It's just an aspect of trading that's like pretty crucial to me anyway. There's a plethora of chart formations out there. Today we're going to kind of talk about the most popular ones, just give a brief overview, and then after that we're going to kind of look at one that you don't really see very many places, but it's the one I got taught from my favorite mentor, Dwayne Archer. He got taught by a gentleman named Charles Goodman in the 70s. So that's what we're kind of going to do. We'll go over the basic ones first, the most common ones and the ones that most people know, and then we'll go into that. I'll give you some real live examples of the PTS, and then kind of just give you theory on these other ones. To start with, we'll go over, let's do this first, let's see. We'll go over the double top formation and the head and shoulders. So these ones I actually use quite a bit. These are probably the only two that I really look for. They're the most reliable to me. The reversal formations. So if you had, say that you can't see this outside of the screen, but this is an uptrend, and then so you're making higher highs and higher lows, but then all of a sudden you're not making higher highs anymore. So it's a change in directional movement, and then it also gets this support line right here. So what happens if you see it respected again, there's a high chance that it's going to respect it and go back down. Now, if you're entering on this, one way, if you're just using this pattern by itself, would be to extend your trend line right here, right, to the next bottom thing. We talked about this in the trend line thing when we talking about directional movement change, right? So in that bottom right there. So it'd be safe to enter probably right when it breaks this new trend line. But if you really wanted to be super secure about this, you'd wait for it to break that. So I'd either enter here or here. I think the preference would depend on what overlays you're using. Like if you're just using this pattern by itself and they're like, oh, we got this spinning top and then you got a bullish candle, or a bearish candle, excuse me, right here. And so that's my overlay. That's kind of weak, but say this was at like a daily high or some other significant level, then it'd be safe to enter right here. But if this wasn't, then it might be better to make sure that this is making lower lows, at least wait for a candlestick to close below this. Problem with that is that you're going to have a higher or a lower risk-reward ratio, so your risk is going to be higher. So if you're going to enter right here, you might want to put your stop right here. But if you enter right here, your stop's a little closer. So I don't know. It's a matter of preference. Personally, I'd probably enter right here. But given that this is at a different level or a significant time, we'll talk about time later. Let's say this was at the opening of, or like 15 minutes before the opening of London or New York, and I saw this. That's an overlay too. It often reverses. We'll talk about that later though. Actually, we might use these patterns again in that video and talk about time in more detail. Anyway, let's see here. Moving on. Head and shoulders pattern. Well, double tap is easiest format, right? So basically it's just to review before we go on. It's just where you're either, if you're in an uptrend, price hits one level and then bounces and then hits a level and respects it again. That's a reversal. If you flip this and imagine this is a downtrend, and say that right here the price moved up and then went down again, so it went like this. That's a double bottom. So you got respected. So you got this same formation, but it's when it's going down. That's reverse formation till up. So it's just a double formation. It's just anywhere on a chart where price bounced twice. Okay, price bounced twice is a double top. Anyway, to move on, there's also triple tops. You know, I'd say the more time price is bouncing from a location, the higher chance that that's going to be a complete, you know, a reversal point. Given some other circumstances, which is a triangle. But let's go to head and shoulders first. At head and shoulders, it's basically where price went up, found resistance, went down, went up a little bit, found resistance, and then went up, and then found resistance at the same spot. Price found resistance twice right here, right? At this level. This is also a reversal pattern. Whether, you know, this is an uptrend, obviously, this is a bearish reversal, but if this was in a downtrend, you know, this would be the lowest point. You know, these would be the second lowest point. It is a reversal pattern. So just the reason it's called head and shoulders, look, this is one shoulder. Imagine this is a person. So we can put a little smiley face right here. This is his head. And we'll put stars for his eyes, right? And then a little smiley face. This is kind of, we'll put that as a nose. There's a little face, right? Head. And then if you imagine it, kind of his neck going down. All the way down, you know, like right there, to his shoulders. And and this is basically forms like, kind of like a portrait of a person if you look at it like that. You know, having some imagination. The neckline is more like the tie line, I'd say, if you want to look at the person. But what it is there's a common area of support, and it's right here in this red line. Sometimes this is going to be sloped, sometimes it'll be straight, sometimes it'll be sloped up a little bit. But it is common area support. Now there's two places you can enter. I would either enter like right here. If I saw this candle in this huge shadow, we talked about candlesticks, this huge shadow right here. So there's, you know, support and resistance right here, boom. And then I'd put stop up here. And that's the best risk reward ratio. Probably the highest percentage of success, though, is if this candle broke this neckline and then attempted to move back up but failed. See if this was extended out, failed, and then bounced back down. And started backing back down, I'd say that's the highest percent chance. But again, if this, you know, this is the best risk-reward ratio, this is a higher percent chance. We'll talk about money management in a later episode. There's another way of looking at money management other than risk-reward ratio. It's called expected value. We'll go into some of those calculations later. But, you know, like I said, again, this is an overlay. There's a certain time frame this was happening, or this, you know, it was at a pivot point or a Fibonacci level or something like that. Then yeah, you have more than one tool on your side, and I'd go for it and enter right there. If not, then it would be much smarter to enter right here and just maybe just have to, you know, put your stop right here. But so those are my reversal patterns, other than the PTS formation, which we'll talk about briefly in a little while. Now wedges can be reversal or continuation, depending on where they are and what they look like. Now this is a rising wedge. Now this is in this situation, this formation is a reversal because it's coming from an uptrend. It's moving up. Price is moving up. Now the reason it's called a wedge is because see how we're getting higher lows faster than we're getting higher highs. So this is forms like a wedge formation. You can see it, right? Ooh, like something you'd put under like a doorstop or something. Oh no, yeah. You get the idea what a wedge is. Anyway, so this is a reversal. Now say you had a rising wedge on a downtrend, that's a continuation. Say this is going down and you had this same thing. You had, getting higher highs, but you're getting higher lows faster, then that's a bearish continuation. Now let's say that, let's see here. Where did I have this? I had a different thing I wrote earlier. Now where did it go? There it is. A falling wedge is the opposite. It's where you're getting, say that you're getting lower low or higher highs faster, or lower lows. Say this is the opposite. This is what it is. I don't use these as often, so I'm trying to use some reference stuff that I used to have. So let me explain this better. I use these sometimes, but the falling wedge is the opposite of this. Okay, say this is a downtrend, and then you're getting lower highs and lower lows. A falling wedge is when you're getting lower lows or lower highs faster than you're getting lower lows. And say that if that was during a downtrend, that's a reversal formation. If that's in an uptrend, it's a continuation formation. Well, moving on. I'm not that knowledgeable about it, but just be aware of them. If researching more wedges, a lot of people use them. I do look at triangles, especially this kind of right angle triangle. See the difference between a double top and a triangle. See that the price respected the level more than once. The difference here is that you're getting higher lows still. So this could be either a continuation or a reversal. You gotta watch for this. Are the lowers getting higher? Even though you have respect and resistance, if that's the case, it's kind of an in-between place, and I wouldn't respect the formation as much. There's a lot of literature that says that this is definitely a continuation pattern, but there's also literature that says no, it's reversal. In my opinion, it's both, and you need more than one evidence to support which way it's going. I would just leave it alone. Pennants are continuation patterns, and they're great ones. Let's say that you are trend following, and let's say that this was price jumped and then made went back down and made this low, right? This also has to do with time. You got expansion and consolidation cycles. Kind of jump ahead. So price expands and then consolidates, and expands and consolidates. So this is a consolidation formation, which is also a continuation formation. See what happening is price is just getting a lower, like a narrower range, And so what you're looking for in entering this is to price to break this kind of trend line, this little resistance line. And then also the trend line, if this is a lower low and this is an actual trend line, this black line I drew, I would actually wait for it to break both this and to find support right here, and then buy right here. It's a great one. Pennants are great. I know these ones pretty well. I do use these as I'm in trend following mode. So those are the most common formations used. Now let's talk about the one that I use the most. I'm not going to save this. I'm going to do new. Don't save. So let's see here. This is a PTX formation. I'm just going to use lines because it's also called trade the line. So what you're looking for here is you're looking for a move up or you're looking for a move down, after which, oh crap, forgot you gotta click out, and then it's a reversal formation. So the basis of it to start with, look at this right, is that price usually moves in a parry or thrust, parry, thrust. So 1, 2, 3, basis of any wave, right? Now, this is where the propagation comes into play. So you got a parry, thrust, parry. Oops, let's try to do it again. And then you have another parry. Now given the 50% move, ideally this parry right here should be 50% of this light green line. If you want to read more on 50% rule, there's a great book is called Trident by Lindsay. Also Secrets to Wii Trading. They talk about the 50% measured move rule. So what happens is there's equilibrium at 50% of this thrust, the main move in the trend. So this is if we have a retracement price. This is like the best place for price to reverse is 50%. Just remember that. And I kind of drew this awkward, but this green line is supposed to be equal to this lime green. That is the measured move. What the measured move rule is, I might as well just rewrite it because it's not confusing. It's not going to work. Yeah, it is. So that's the same size, right? So what the measured move says is that once price goes 50%, this move is going to equal to this green one. Okay? So this is the thrust, parry, thrust. And now here's the propagation. Oops, now stay green. Now, what Goodman said was, okay, this whole thing now becomes one move once it has a parry, thrust. I better not make that green. Let's make it red. So this now becomes one move. This whole line. This propagates into this. So this 1, 2, 3 now becomes a 1. And what's going to happen next? If you follow logic, you're now looking for price to retrace back up to 50% of the red. Okay? Back to the 50% rule. And then, once again, you're looking, oh come on, don't do that. So, once again, you're going to look for price to do the measured move rule. Say you're looking for price to come back down to equal the red. So, measured move. And that's the base of it. You're looking to enter right here. So, 1, and then you have the parry move, and then the thrust, second thrust, and then price moves back up. This is where it propagates, so now you have this one line that equals the whole move, right? And then, so there's an uptrend, price comes back here to the 50% move. There's an entry right here. You're looking for it to enter right here and for it to go back down. The reverse is true when you're in a downtrend. So, downtrend, you're looking for a reversal. 1, 2, 3, becomes a 1. Boom. And then you're looking for price to come back down. And you're looking for a buy right there. You're trading for these, right? For this whole line to come back here. And then to come back here. Or back here. At the same angle, okay? So that is the theory. Now, for the remainder of the video, we're just going to look at a real-life example. And then, call it good. If you have more information, or if you seek more information, look up Dwayne Archer. His website's goodmanworks.com. He's a great author. I still think he takes students, but he's about in retirement, so I'm not sure. I haven't talked to him for a little bit. But let's see if we can find a PTS in real life. Let me take this grid lines off because I know it looks like crap when you're recording. Let's see. So properties. So you can change all your stuff here, right, for your chart. There's a bunch of stuff. Other videos even on this site that I'm doing this for. So, but I'm just turning the grid off. So you go to common after you go to properties and you just click off grid. Okay. Now, so here's the PTS right here. This is a pretty good one. So look, 1, 2, 3. Okay. There's the basic 1, 2, 3. Now that 1, 2, 3 becomes a 1. I think it would, hopefully it's this one. So this is how you edit. See how I did that? If you're drawing something, you go to your object list, and then to edit the color, just go to edit, and it'll change this to, let's say, how about red now, because we got red candles. Let's do green, and we'll make it bigger, okay, to signify it's a bigger wave. And that didn't make sense because that's green, obviously. Apparently, I'm just looking at it and subconsciously making the same color. But we'll make it blue, okay? So, anyway, so the 1, 2, 3 became a 1, 2, right? So this is what you're entering. 1, 2, 3 becomes a 1, 2. 1, orange line. 1, 2, 3 becomes a 1, 2. That's a propagation, wave propagation. So when that happens, what you're looking for is around the 50% move rule. I mean, this isn't quite 50%, obviously, it's a little under, but you're looking for it to propagate. That's ideal, but it doesn't have to be ideal. As you can see, this is Fibonacci tool, but I changed the ratios. So, one, two, three. So basically, this should be moved out a little bit right here, but because the same bar is the single bar is a single thrust move. But as you can see, it bounced at the 87%, which is at kind of another level it might bounce at. It's basically saying it retraced 87% chance. That goes into more Goodman trading. I'm not going to go into that, but basically what you're looking is to a thrust parry thrust, which becomes a thrust parry. Now, how do you know if it's going to bounce right there? Well, we simply go down in time frame, and we got to turn this off. Where to go? Go back now. Where are you? Where was it at in time? So right there, 23rd is when it was. So right there. See? And what are we looking for here? We are looking for candlestick formations. And see, once I saw it, we're talking about candlesticks right there. Look, right here, insert shapes, triangle or rectangle. Right here is railroad tracks. Not only that, but see how the shadows, you draw it from the shadows when you draw it, but see where the shadows aren't, that's a basis support. So I looked for these, this is a really profitable trade. Look for the railroad formation and a basis support, previous market support. So, and look what happened. Move back up, boom. All this. If you would have entered here, look how much price went up. And look, we'll do one more thing real quick. This is, let's see that 1, 2, 3. 1, 2, 3 becomes a 1, 2. Again, that bigger 1, 2, 3 becomes a bigger 1, 2, and you could have entered right there. This is a PTS, the basics of it. If you want to look up more, just look up propagation trade setup. It's all over. There's a free YouTube video that explains it more in depth. We don't have time right now. That's the basic of it. So this kind of concludes our look at trading chart patterns, and I kind of gave a brief overview and then went into more details of my favorite. I hope you enjoyed it, and good trading.